Do you know what truly defines an investor? It's not picking the right stocks or timing the markets for a perfect entry. Honestly, anyone can get lucky once or twice. But the real game is how you manage your emotions when the markets are falling and crashing, when everything you thought you knew feels like it's falling apart. Welcome back to the Inner Game podcast. Today, I try to dive into something every investor faces but rarely prepares for, and that is a market crash. The Indian markets are in a turmoil of their own. The Sensex has dropped by 11% in the last 5 months, while the small cap and mid cap indices are down around 18% each. If you read social media, it's full of panic posts, and in your WhatsApp groups, probably have more expert advice than a financial conference. But the thing is that this fall, like any, is not just a financial event, it's an emotional stress test. And today, I'm going to talk about how to pass it. So, just like banks go through stress tests to provide they can survive financial shocks and setbacks, investors also face an emotional stress test when markets tank. And it's not about numbers anymore, but about the mindset. Market crashes don't just test your portfolio, they expose the cracks in your thinking. They reveal how fragile or resilient your emotions are when your investments take a hit. And that's where the real challenge lies. Let me now introduce something that might change how you see this crash: the investor's emotional balance sheet. Imagine this like a regular balance sheet, but for your mind. Just like companies have financial balance sheets to track their health, every investor has an emotional balance sheet that reflects their mental and emotional well being during volatile times. And trust me, it matters just as much as the numbers on the annual reports you are reading. Let's look at each item of this balance sheet one by one. And if you are listening to this podcast and not watching, I'm going to share the link of the balance sheet in the show notes. So, on the asset side, you've got patience, you've got conviction, and rational thinking. These are the three assets that you have. Let's take patience first, which is not just about waiting, but about enduring the discomfort of seeing your portfolio in the red without making any knee jerk reactions or decisions. It's important to understand that wealth does not grow overnight, it grows quietly, often when you are doing nothing. The second item on the investor's emotional balance sheet is conviction, which is about having a strong belief in your investment process and choices, even when the market is basically yelling in your face that you may be wrong. Now, this is not stubbornness, but it's grounded in research analysis. It's grounded in understanding and knowing why you made the decision in the first place. And then there's this third part of the balance sheet or the asset side, which is rational thinking, which is making decisions based on facts and logic and not emotions. It may sound simple, but when fear kicks in, logic often takes a backseat. Rational thinking helps you zoom out, it helps you see the bigger picture, and it helps you avoid becoming your own worst enemy. Now, just like any balance sheet, there are the liabilities. Fear is the number one culprit behind panic selling. It magnifies your losses in your mind and makes a temporary dip feel like the end of the world. Then the second item on the liability side you can see is herd mentality, the everyone's doing it syndrome. It's easy to get swept up in the crowd, but remember, the crowd is not always right. Often it follows emotions, not facts. And let's not forget the short-term focus that most people behave with as far as investing is concerned. It's where you obsess over daily price swings like your life depends on it. The fact is that it doesn't. This mindset of short-term thinking only leads to stress, it leads to poor decisions, and probably a lot of sleepless nights. Now, the most interesting part of this balance sheet is its third side, which is emotional resilience and which is your equity. Emotional resilience is the ability to take a hit and not fall apart, and what keeps you grounded when everything else feels shaky. It's not about never feeling fear or doubt, but about not letting those feelings control your decisions. You build it through experience over time, you build it through reflection, and sometimes by simply surviving tough times. When markets are soaring, it's easy to call yourself a long-term investor, and a lot of people do that. But when prices crash and the markets crash, that's when your true emotional balance sheet shows up. And for many, the liabilities are bigger than they thought. When I look around, I see that most investors today are young and they started their journey after 2020 when markets were basically on steroids. Quick dips were followed by quick recoveries, and it felt like you could not lose. But this fall looks a bit different. Nobody knows till when it is going to last, and there's no magic recovery button. But for many, this is the first real taste of financial discomfort, where hope doesn't bounce back overnight. But the thing is that this fall, like all market falls in the past, is not a curse, but a rite of passage. Every seasoned investor has scars from market crashes. They're badges of honor because they teach you lessons no bull market ever can. Now for the key question: how do you deal with it? First, my same old advice: try journaling. It sounds simple, but it's powerful. Write down your thoughts, your emotions, and decisions as the markets fall, and so do your investments. In 5 years, this journal will be your most valuable ally than any stock tip. It'll show you how you grew as an investor, and not just as an investor, but as a person. The next thing you can do is that before you hit that sell button, pause, breathe, ask yourself, am I making this decision based on fears or facts? Often it's not the market causing the stress, it's your reaction to it. And finally, zoom out. Imagine your portfolio as a forest and not just a single tree. A tree may wither temporarily, but the forest thrives over time. Market crashes are like harsh seasons. They're tough, but necessary for growth. And finally, revisit your why. Why did you start investing in the first place? Was it for quick wins or long-term wealth? True wealth, as we understand, is built through market cycles and not despite them. So please understand that market crashes are not new. They've happened before and they'll happen again. What matters is not the crash itself, it's how you respond. And also remember that while markets fall, financial fortunes may shrink, but the invisible wealth, which is your patience, your wisdom, and resilience, it compounds forever. This is not just a test of your portfolio, it's a test of your character. That's all from my side today. If this resonated with you, please like, subscribe, and share it with someone who might need to hear this. Stay calm, stay invested, and most importantly, play the inner game right. Thank you so much for your time.